Welcome back to the deep dive. Our mission today is a really rigorous assessment of one of the most powerful players in the online travel market, MakeMyTrip, or MMYT.
That's right.
They are the absolute giant in the Indian market, and their recent filings are, well, they're shouting about this robust post-pandemic growth.
Yeah, that 30% jump in Q1 gross bookings is the flashy headline. It's absolutely driven by a recovery in international travel and some pretty smart moves into new areas.
But that's not the whole story.
Not even close. Here's the central paradox we're tackling for you today. Is that phenomenal growth rate actually viable long-term?
We're diving past those big booking numbers to look at the structural weaknesses.
Okay, like what?
Specifically, a persistently low operating margin compared to, well, any global peer. Then you have marketing costs that are spiraling and a heavy ledger of regulatory and supply chain liabilities that management, frankly, can't ignore anymore.
Okay, let's unpack this. We should probably start with their market dominance because it's staggering. It really is. Founded back in 2000, this company isn't just a competitor. They're, an essential part of modern Indian travel.
A fortress?
A fully consolidated powerhouse. They operate through three huge, deeply integrated brands. The main MakeMyTrip, the budget-focused Godibo, and then there's the sheer scale of RedBus for ground transport.
And the numbers back that up.
Oh, absolutely. When you look at their FY 2024 performance, you see just how dominant they are. Total reported revenue hit $783 million.
The penetration stats are almost unbelievable. During that fiscal year, they estimate nearly 1 in 3 domestic air passengers in India book through one of their platforms.
1 in 3. That kind of market capture is what investors dream of. It's infrastructure-level volume.
So what does that translate to in actual bookings?
It's huge. 42.1 million domestic flight segments, 31.1 million hotel room nights sold, and get this, 86.8 million bus tickets.
86 million. Wow.
They are the backbone of domestic travel, which, really explains their corporate strategy.
Yeah. Which is just maximum consolidation. They already swallowed Godibo in early 2023.
And now they're integrating RedBus, the bus giant, into MMT India. The board greenlit that back in March 2024.
So that's still in process.
Correct. It's currently waiting for approval from India's corporate tribunal, the NCLT, and other regulators. But the direction is clear. Merge these high-volume operations and squeeze out every possible efficiency.
To save money.
Primarily to save money. And that's where the whole narrative kind of hits a wall.
Because while the scale is magnificent and those Q1 2025 gross bookings grew over 30%, the core financial reality is grim.
The growth is real, but it's expensive growth. The critical point for you to understand is the margin challenge.
Right.
If you're operating at this kind of scale, you should be generating world-class profits. But MMYT's adjusted operating margin for FY 2025 is a shockingly thin 1.64%.
Wait, 1.64%. Let's put that number into perspective. How does that compare to, say, Expedia or Booking Holdings?
It's not even a comparison. I mean, it's not in the same ballpark. In 2024, Expedia hit an adjusted operating margin of 14.3%.
Okay, so way higher.
And Booking Holdings was at a massive 22.0%. MakeMyTrip's 1.64% isn't just a lag. It's a structural failure to monetize that dominance.
They're running the biggest travel business in one of the world's fastest growing economies, almost at cost.
Exactly. It suggests they're just buying market share at a global loss.
So is there a saving grace? What's dragging that number down so hard?
The one bright spot is their highest margin segment, hotels and packages. It contributes 53% of total revenue and has a solid 17.8% adjusted margin.
That's their core value engine.
It's what keeps the lights on. But the rest of the mix is just an anchor.
A high volume stuff.
Precisely. The segments that give them that incredible market penetration are the profit killers. Air ticketing runs at just a 6.4% margin.
And buses.
Only slightly better at 10.2%. Because these low-margin, high-volume businesses make up so much of the revenue, the overall profitability just gets decimated.
And I see signs of pressure even within their strongest segment, hotels.
Yes, good point. 15% of that segment's contribution actually comes from less profitable, non-contracted affiliate partnerships.
Which squeezes margins even tighter.
It does. It hints that even in their best business, they're constantly running up against cost pressures just to keep bookings flowing.
That pressure is relentless. So where is all the money going? This leads us straight to their biggest weakness, the war for the customer.
Customer acquisition cost, or FAC. It's escalating at what looks like an unsustainable rate.
How bad is it?
The spend is accelerating faster than revenue. Their marketing and sales promotion costs jumped over 21% in FY 2024 to about $123 million.
And it's getting worse.
Much worse. If you look at their Q1 2025 numbers, the annualized run rate is now $165 million. That's a staggering 34% increase in spend year over year.
But wait, if they're consolidating 3 massive brands and have loyalty programs, why is their marketing efficiency ratio still worse than it was pre-pandemic?
That is the paradox, isn't it?
Shouldn't scale and consolidation bring those costs down?
It should. They are cross-selling effectively, but they're clearly spending a fortune just to keep competitors out. Their marketing efficiency as a percent of gross bookings is now 4.8%.
And pre-pandemic?
It was 4.6%. They're pouring an extra $40 to $50 million a year just for a marginal gain in efficiency. It shows their dominance is being bought every single quarter.
Not generated organically.
Exactly. And that's money they might urgently need somewhere else, because the operational costs are just one part of the story. They have significant and immediate liabilities.
Let's get into those. Let's start with the supply chain.
The grounding of Go Airlines, or Go First, was a really harsh reminder of this risk.
Right.
Following that flight suspension, MakeMyTrip's still has an outstanding $20.9 million advance on its books.
And that includes customer refunds.
It includes $10.9 million in customer refunds that they haven't been able to get back. That is a substantial, unwritten-off exposure to a single airline failure.
And on top of that, there's a currency risk baked right into their accounting model.
A profound, unmitigated exposure. They earn in rupees, but report in US dollars.
So they're making an unhedged bet on the Indian currency.
They are. A sensitivity analysis from their own filings shows that if the US dollar were to appreciate by just 10% against the rupee,
which is very plausible in emerging markets.
Very plausible, it would decrease their annual profit by $21.5 million.
Which, against that tiny 1.64% margin, is just devastating.
It completely craters it. And then you have the regulatory overhang, which is substantial and potentially very, very costly.
The anti-competitive conduct cases.
The biggest elephant in the room is the penalty from the Competition Commission of India, the CCI. They're appealing a massive penalty of roughly $26.1 million.
For what, specifically?
For alleged anti-competitive conduct and abusing their dominant position in the hotel booking market. If they lose that appeal, that cash just vanishes.
And while fighting that fine, they've also lost a key legal battle against some rivals.
They did. Their trademark infringement case against Booking.com and Google, which was about using MakeMyTrip as a keyword in ads.
I remember that.
It was dismissed by the Supreme Court of India in March 2024. The case now proceeds without the interim protection they wanted, which means a higher cost to protect their brand online.
And new data privacy laws are tightening the screws even more.
Yes, the Digital Personal Data Protection Act, or DPDP Act. This isn't just a fine risk, though the penalties can hit $30 million.
It's an operational cost.
It's a permanent increase in operational overhead. Compliance requires fundamental changes to how they do business. Every dollar they spend on data governance directly eats into that minuscule margin.
Okay, that is a heavy list of risks stacked on top of an already thin margin. Let's pivot to their counter strategy. They're not just sitting still.
Not at all. Their acquisition strategy is all about smart vertical integration. They know they need revenue streams that aren't just reliant on commissions.
Like, what have they done?
In 2022, they bought a majority stake in BookMyForex, which is foreign currency exchange. In 2023, they acquired Quest2 Travel for corporate clients. And earlier this year, they picked up HapPay, an expense management solution.
So, fintech, corporate travel, this is what they call their ancillary services segment.
Right, and that segment has almost doubled its revenue contribution. This diversification is crucial because it generates stickier, potentially higher quality revenue.
But is it profitable?
Well, that's the question. Profitability here depends on managing high-cost integrations, like their car rental service Savari, versus low-overhead things like insurance. They haven't really proven the high-cost side can deliver consistent profit yet.
And circling back to efficiency, you mentioned the RedBus consolidation. That's being helped by a recent regulatory shift in India, isn't it?
That's a hugely important point. India's Ministry of Corporate Affairs passed the 2025 MCA amendment, which greatly facilitates complex restructuring, like this merger.
It's a huge operational win for them. How exactly does that help speed things up?
It significantly expands the fast-track merger route. Crucially, It now permits mergers between non-wholly owned holding and subsidiary groups, and it also covers what are called hive-offs, or transferring divisions.
So they can consolidate much faster and cheaper.
Way faster and less expensively than before, which is vital for a company that is scrambling for every ounce of efficiency.
So if we step back, we have this massive Indian leader with undeniable growth. It's aggressively diversifying and streamlining. But that success rests on a deeply fragile financial foundation.
That's the perfect summary. A tiny 1.64% profit margin, exploding marketing costs, and these non-trivial liabilities.
It's an operational tightrope walk.
It really is. Their success hinges entirely on pivoting beyond that low-margin commission model and absorbing all these rising compliance costs, all while fighting off fierce competition.
This incredible tension between preserving market share and preserving the balance sheet brings us to our final segment. This is not financial advice.
And this thought experiment is based entirely on publicly published data. It's for educational and scenario testing purposes only.
Okay, so MakeMyTrip is facing a classic dilemma: growth at all costs versus cash preservation. On one hand, they have a solid balance sheet sitting on a huge liquidity pool of over $760 million.
As a fortress. But that fortress has a clear, massive, and rapidly approaching hole in it.
The convertible notes.
Exactly. $230 million in convertible notes that holders can force the company to repurchase on February 15th, 2026. Management must have that cash ready.
At the same time, to protect their market share and fuel that growth, they're burning through $165 million a year on marketing.
Which is the exact cost keeping their margin pinned down at 1.64%.
So the trade idea.
The plausible but outrageous trade idea here is to bet on management prioritizing cash preservation over sustained breakneck growth.
Especially with that 2026 put obligation and the potential $26 million regulatory fine.
They simply cannot afford to bleed $165 million every single year just to chase growth.
So the thesis is that management will be forced to drastically cut that marketing budget to conserve cash for the debt repayment.
And that cut would immediately cause a sudden, sharp deceleration in volume growth, which would shock the market and could trigger a stock price collapse.
So the trade itself.
The trade would be to short MMYT stock, betting on that forced growth slowdown.
Yeah.
And simultaneously, you could long the $230 million 2028 convertible notes, betting on the guaranteed principal repayment in 2026.
It's a hedge.
It's a sophisticated hedge. You're betting the cash-rich balance sheet will hold, while the operational growth story will fail. Again, just a framework for analyzing financial tension, nothing more.
That is quite the tension. Thank you for joining us for this deep dive into MakeMyTrip's flight path. We hope these insights help you contextualize the challenges facing any market leader who operates on these extremely thin margins.
My final thought for you, the listener, goes back to those game-changing Indian regulatory changes, the 2025 MCA amendment.
Right, the fast-track mergers.
Given those new rules, which allow for rapid consolidation in these hive-offs, what other large, complex corporate groups in India who are sitting on diverse portfolios in competitive markets might be preparing to restructure?
To shed assets or consolidate risk before they face the same pressures.
Exactly. The question is, how swiftly will India's corporate map be redrawn by this new agility?
We'll leave that thought hanging. That's all for this deep dive.